Well, stocks are higher today as data shows that consumers have tempered fears surrounding inflation. You're looking at the Dow up just about 0.1%. The Nasdaq now up about 0.5%. On the move higher this morning, coming after markets fell yesterday when Nvidia was unable to calm some of the fears surrounding higher for longer rates. So what's ahead for the market? What's going to be the biggest driver for those moves? We want to bring in Matthew Palazzolo. He is Bernstein Private Wealth Management Senior Investment Strategist. Matthew, it's great to have you. So I'm curious how you looked at the action that we saw yesterday and really what that signals here for the market's momentum going forward, because in the past we've seen lots of excitement surrounding Nvidia's blowout results. Yet when you take a look at yesterday's declines, you have Nvidia closing up 9%, yet the market sold off, a bit of a reversal today. So what does that tell you just about the narrative right now of the market?
I think it basically shows you the tug-of-war that's occurring in investors' minds between earnings growth, which over the last few quarters certainly has been solid, but then also the inflation data, which depending on the data points that you're looking at, has been more dovish or has shown some acceleration. Certainly in the first quarter, that was the backdrop. So I think the last couple of days are just evidence to that investors are grappling with these two somewhat opposing forces and trying to get a sense for whether or not we're going to continue to hit highs in the S&P 500 or have to give some back on some profit taking.
And if there is some profit taking, that means perhaps we see a little bit of volatility, a little bit of dips. Where do you think, even within that profit taking, investors might find other areas to reallocate?
Yeah. So, we have to look at in those situations as investors, the areas that can navigate through a softer economy. So on that score, our portfolio managers like healthcare, they like staples. They're somewhat protective in a downturn. And if you look at valuations for those sectors today, they would support a downturn and some additional volatility. And then if some of that inflation continues to rise, then there are areas like energy and others that would be able to maybe appreciate or hold their value in some of that volatility. So across the board, we're always looking for quality companies, no matter the sector. And we're having great opportunities today, given valuations on some sectors outside of technology, where you can get high quality businesses that have good solid balance sheets, good top and bottom line growth that aren't expensive.
Matthew, I'm curious, how are you looking at the timing of rate cuts, just in terms of, clearly we've been talking about it a lot, but how much does it actually matter to the market's momentum and gains here, at least in the short term?
Yeah, Matt, I think what matters more than when that first cut occurs is that they've started and the direction of travel from there. So we, like everybody else, have changed our first cut to further out in the year. We've now penciled in a fourth quarter cut, perhaps at that last meeting in December. But from there through the end of 2025, we've got roughly 100 basis points of cuts baked in. So I think that is more important, that they've started, and then the magnitude of the cuts over the next 12 months or so. And I think if that ends up being the case, and that's our base case, then from there, that should be supportive of earnings growth and also supportive of investor sentiment.
Does a cut then kind of reposition, or does that change the playbook for investors?
I don't think it should. The consensus obviously is around 2 or maybe 3, depending on the day, cuts over the balance of this year and then into 2025, more to come. So it shouldn't change the belief amongst investors all that much. Again, I think it'll just be a sigh of relief for investors that the Fed has started, that they feel like they have air cover given the inflationary backdrop at that point in time to begin that process of easing financial conditions. And then from there, the markets will then focus more on the earnings backdrop and the labor backdrop, which we believe should continue to be supportive. Earnings can grow mid to high single digits over the next handful of years. And we don't think the labor market is going to soften all that much that it'll end up being disruptive to the economy.
Matthew Palazzolo, we really appreciate you taking the time to join us here this morning. Bernstein's Private Wealth Management Senior Investment Strategist. Have a great weekend.
Thank you.